Today we're going to be looking at an upcoming burger joint with strong technology, commitment to sustainability, and advanced digital marketing strategies. They also are sure to meet all dietary needs with an extremely customizable menu.
BurgerFi uses Sprinkler because Sprinkler allows the individual restaurant managers to be able to get live feeds daily from their customer feedback, not the brand as a whole. So it really allows their individual restaurants to thrive.
Looking at their financials, there's a few interesting things here that stand out to us. First of all, they have a really strong prime margin. That's 44.75%. Next up, they have an 1840 average transaction. That's total sales of 2019 divided by the total number of transactions in 2019. And when you're looking at the average check per person stat here, you see $13. That's the average cost per meal, where you're looking at an average burger, fries, and drink combo at any chain. When you look at this company, it's really interesting to me that they actually have no debt, and they're going to be looking at $42.7 million in cash on the balance sheet once the merger goes through. Right now, based on their estimated 2021 earnings, they're looking at a 2.4 equity value divided by net sales. Also, we did a little math for their current price to sales. If you use the implied equity value of 186 million and divide that by their 2020 estimated earnings, you're looking at a price to sales ratio of 1.65. And that's at a valuation of $10.60 per share. At this valuation, 23% of their market cap is actually covered by cash. And right now, their total shares outstanding is 17.6 million. As we talked about with our risks, one of the risks is that their share count increases and they have heavy float because of the incentives for existing shareholders.
BurgerFi uniquely targets venues such as airports, transportation hubs, travel plazas, higher education, military bases, and supporting venues, they claim. And they work with a company called Aramark, where they work with higher education. It's these little places that if you go on college campuses, that they just have it's like a mini version of the actual restaurant. They opened up one in Temple University, was their first one, and now since working with Aramark, they've now opened in University of South Florida, Philadelphia, and so on.
Some of their competitive advantages are their alcohol sales, their fresh, modern variety of options.
I got options.
Their average check per person is significantly higher. And they also have modern, efficient technology to help them scale their business and keep a high margin. So BurgerFi has also signed a partnership with Reef Kitchens, which is basically a small on-the-go pickup style restaurant. So basically what they do is they buy and actually partner with BurgerFi to use their exact products and sell their exact burgers to companies like DoorDash or Uber Eats or whomever they partner with, where they can quickly get the food to the customers. And it also allows for easy pickup to customers who might not have a restaurant near them, which also gives them more brand exposure.
So on the screen, we can see their net company revenue. Their compounded rate was 36.4% with estimates, and their system-wide store count with estimates is 29.3%. And that's a huge thing to notice, is their revenues are increasing faster than their stores are. So which means those stores opening are making money. So you can see some concentration in the East Coast, but you could really see it down in Florida.
Yeah, for sure. And yet they continue to open locations in Florida. And I think one thing related to that is with the current COVID crisis. One thing we've seen is that Florida is really not too concerned about the whole thing. Seems like even when cases are spiking there, people are still willing to go out. And no matter what you think about that in terms of health or politics, any of that stuff, when you look at the facts, people are more willing to spend money there and people are more willing to eat out. That's just the reality of it. And I think that might be some of the reason that they're choosing to open Florida stores in the short term, whereas then they can use these revenues to open stores across America.
So if you look at the map on the screen, you can see the existing BurgerFis, what's under construction, where they plan on to be. It's really showing a strategic real estate strategy because they're using places that are already built for these markets, and all they're doing is basically just vertical integration in a sense. They're going where the market's already set up, the market's hot and ready for them. They go in
I
and they
totally
go.
agree. I mean, they really want to clearly maintain their brand loyalty
Mm-hmm.
and build brand loyalty, and you do that by having locations accessible to customers in their hometown area. So even if they're on the go at the mall, at the airport, where they're building out some of these locations. When you look at their 2021 growth plan, it's extremely aggressive. They want to build 30 corporate owned units. What that basically means is the company will operate and run these, whereas the other 24 units they're going to open are going to be franchised, meaning they will franchise it out to another owner, an individual restaurant owner, that then pays a percentage of their revenue to BurgerFi. Whereas corporate owned units will hold more value because they'll have bigger margins and more profit and stronger cash flow.
Yeah, I mean, as we could see for BurgerFi, they really do have a better burger experience. They say they're a lot more transparent with their ingredients. They talk about how they're never ever program where they don't ever have free range. It's always free range. They're humanely treated and they're raised on vegetarian diets. They really do talk about how they're raised from the cattle to the plate. It's nice to see compared to other places where they just give you the calories and stuff.
Yeah, absolutely. It's evident that they really take pride in being healthy and transparent with their customers.
Yeah, and I mean, we could see too they're being recognized for it. Inc. just named them in the top 500 fastest growing private companies, and restaurant business put them in their top 500 chains.
In the month of October, BurgerFi made a couple interesting corporate moves. First, October 13th, they released a spicy chicken sandwich to diversify their menu even further. And then October 16th, they named Julio Ramirez as their CEO once the merger with Opes Acquisition Corporation goes through. As we know, Joe, this is a special acquisition company, so there is risk to this. What do you see with risk?
Obviously, the biggest risk is it not going through, obviously. But I think over after that would be the expansion into the west, the midwest coast. I think will be the hardest, but I think getting in the west coast in California is gonna be pretty difficult.
Yeah, I think for me it would be, are they really going to be able to sustain the brand the way they think they do and the way they're spending money to? Along with that, we also have to look at the share count. The share count will significantly increase as the stock price appreciates. So if the stock price appreciates, the board and early investors will be further compensated, which will significantly increase their share count. So that could also be a risk where we'd have too much float,
Yeah, it's gonna dilute your profits.
and never like to see that.
You don't.
Well, thank you for listening to our coverage today,
Thank you.
and until next time, peace.
If you want to learn more about this SPAC, look up New York Stock Exchange OPES.
Opes, the Opus Acquisition Corporation, which we will link their website in the description below, where you can find all the information that we used in today's video. And as always, like and subscribe. Thank you for watching.